New SEC rules requiring companies to report pay ratios, that is the ratio of how much money a company's CEO makes compared to its average employee. Well, they are drawing a lot of attention. The focus mostly, though, so far has been on bank CEOs whose multi-million-dollar bonuses we like to report on. But it turns out more dramatic inequalities may actually show up in other industries, especially those with a lot of low-wage workers. Anders Melin has written about this for Bloomberg News, and he joins us now on set. So, Anders, when pay ratio reports start coming out, who's going to have the most explaining to do?
Well, when we spoke to experts, it was the conclusions were that retailers were the ones that were going to come out probably looking worse than anybody else.
And among them, which retailers?
A couple of examples that we brought up that we think is interesting because their CEOs make quite a bit of money is CVS. Larry Merlo made about $32 million, and Carol Meyerowitz at TJX made about $28 million last year.
That is surprising, because when the pay ratio first came out, you were, one company that comes around, you'd think Costco or Walmart, those giant retailers who have a lot of low-wage workers. Walmart employs more than 1 million people domestically in the U.S. You would think that would be the kind of company where the pay ratio might be more extreme.
We think that they're going to be up there as well, but this pay ratio is going to help to highlight retailers that not necessarily appear in the executive pay debate as much.
Well, look, one of the big criticisms of the pay ratio, which I have to admit, I think it feels a little populist, because what is the point of the pay ratio when the nature of the labor force is so different from industry to industry? For a big retailer, yes, they're going to have a lot of offshore jobs. They're going to have a lot of low-wage staff domestically. It's going to be very different for Amazon, who actually just employs a lot of people domestically who make higher-wage tech jobs.
And this is true, and that's what experts tell us as well, that it's going to be very difficult to compare industry to industry. But within an industry, we think it's going to could be a good gauge for investors to see how workers are paid versus CEOs.
Remind us exactly how it's calculated, because companies are able to take, X percentage of the workforce actually off the equation, right?
Yeah, there's a few ways you can get away with that you can alter the calculation. But essentially, you line up all the workers that you have, you pick the median worker, and then you compare that with the CEO's pay and see what the ratio turns out to be.
And what's the SEC going to do with this number, or is it just sort of to add transparency?
They're just going to put it out there to shareholders to look at in proxy filings and kind of see what happens, I guess.
Do we expect it to put, pressure on boards to reduce CEO compensation? I mean, is CVS's board really going to tell Larry Merlo, maybe we're paying you too much because the median...
That'll be interesting to see what is the fallout, because this is obviously going to be good for news media, because it's an easy thing that people can understand, that the CEO makes X number of times what a worker makes. But if it's going to have any tangible effects, we still don't know.
And why TJ Maxx? How did TJ Maxx get on the list?
Ask TJX's board why they pay her that much.
All right. Well, obviously it's going to make a lot of headlines when all these numbers do actually come out. Thank you so much, Anders Melin.